Thank you very much, Rick. And as a matter of fact, stay with us because we got a lot to talk about. China raising its interest rates again in an effort to keep inflation under control, and oil playing into those inflation fears. Crude hitting a new 26-month high. And of course, part of that is because of this winter blizzard slamming the U.S. So what do oil's moves and global inflation concerns mean to the U.S. and investing in the new year? Joining us now is Tom Lydon, editor of ETF Trends, Bob Phillips, senior partner at Spectrum Management Group, and Peter Donovan, VP of Vantage Trading. Gentlemen, welcome all. Pleasure to have you here.
Happy New Year.
Bob, I'm going to start with you if I could, because we do have these inflation headwinds, and oil is part of that. But technically, we did see the S&P break through to some very important levels last week. I guess the question is whether or not that can overcome some of these inflation headwinds. What do you think?
Well, I think that they can. I think when the S&P broke through the 1257 level, which was I call the Bear Stearns low, that was a huge positive in terms of momentum going forward. And I think in spite of all the fears, you really have to go back and look at the volume that's happening in terms of the constant movement upward of the market. I think if the market stays above the 1235 level this Thursday and a close there, I think it portends more good things to come.
You know, how do you look at it, Bob, and we'll get to the others real quickly. On the one side, we have everyone so bullish, so you figured maybe that's a sell signal. On the other side, you have everyone saying that money's going to rotate furiously out of bonds, and that's bullish for stocks. I mean, a lot of people are nervous about putting new money at these levels.
Yeah, there's no question. Sentiment is very, very high. In terms of the market being overbought, it's very overbought. But I think that's been kind of the trend since we came off the July of 2009 when the market was at 950. It's been this constant upward trending thing that's been later on reinforced by good earnings and better than expected sales. I think that trend continues because of the fiscal stimulus the Fed's providing with QE2. So yeah, I know it's tough at this level, but I think the odds are for an increased market 2 or 3 months from now.
Peter Donovan, though, the move that we're seeing in some of the commodity markets, oil, of course, front and center today, has a lot of people worried about whether or not those inflation fears that we've been talking about here on CNBC for some time are really coming to fruition. How much more upside does oil have at this point, do you think?
Well, moving in the very short term, it seems somewhat limited, but moving forward, it's pretty significant, and it's certainly on traders' minds. The QE2 and the economic stimulus certainly flooding the market with dollars. Oil is priced in dollars, and it's definitely on traders' mind moving forward that as a currency play, there's significant upside for oil.
Tom, make the case for metals. You know, the same sort of toppy feel is there, and a lot of your reasons in your notes are sort of backward looking. I mean, make the case for metals and then maybe where people could go if they want to give it a shot.
Right, everyone's been talking about gold, but if you look at the base metals, in particular copper, aluminum, zinc, there's some great opportunities there. And this rate hike that we saw in China has basically been shrugged off. So there's momentum. There's demand, there's lower supply over in China right now, and areas to play like the power shares, base metals ETFs. That's a great opportunity right now, I think, as we go into next year.
You know, Rick, do you agree that the market has shrugged off the China rate increase? And in your opinion, do you think that China is doing an adequate job of trying to cut off inflation, or should they be more aggressive?
Well, I think they're being very adult-like, very responsible. They have many social issues that are going to be associated with the rise in inflation. The Wall Street Journal had a great piece about how it affects the lower economic strata. And I also think that considering the dollar-yuan relationship is linked, that this is an issue, and it's going to expose part of the red herring of how the Fed looks at oil and then subtracts out food and energy. There's going to be an amazing amount of pressure on the Fed. So if you believe that QE is a big positive for stocks at the moment, or you believe bond funds outflows are big positive for stocks, you know, there's going to be a split call on both of those considering China's activity.
Very quickly, and someone touch on this, anyone take it, whoever jumps in first. I mean, if China continues to hike at this rate and we stay still, that is bearish for a lot of commodities and metals. Is that not right? I mean, that'll strengthen the dollar. Is that the wrong way to look at it?
No, I think that if you look 2 weeks ago, China announced that they're accepting a higher than expected inflation rate. They raised it from 3 to 4%. They're going to err on the side of growth, I believe, in their economy. And they're starting a new 5-year plan in 2011. Local governments have new projects to start. I think you can expect that they're going to have probably a pretty decent year growth-wise and err on the side of higher inflation.
All right, gentlemen, thank you all. If I don't see you, Happy New Year.
Happy
Although,
New Year.
Ricky,
Thank
I'll
you.
see you before the new year.